In Lesson 7, we learned about the efficient market hypothesis. We learned that although the market price is almost surely wrong, it's also almost surely fair. It's as likely to be too high as it is to be too low. That's a recurring theme in several lectures. This lecture will continue to discuss trading and investing strategies, but please keep the key ideas about efficient markets in mind. That will help us sort out good strategies from bad ones. Remember, even if markets are seriously inefficient, then collectively we still just break even, and we do even worse after paying the transactions costs from frequent trading. Think of it this way. If you and I are the only two traders in the market, then anything you make above the market return has to come from me. You bought that underpriced security from me, so that means I sold it for less than it's worth. However much you win, I lose exactly the same amount. If my friend Bud joins the market, then you might win from Bud instead of me, but it's still true that your winnings collectively come out of the hides of the rest of the market players, so the entire market is still just even. Active traders are gambling that they'll be on the winning side. What are the odds of that happening? Mark Hulbert of the popular internet site MarketWatch reported the results of a study showing that 51 financial advisors out of over 200 beat the market in the 10-year period ending April 30th, 2012. That sounds impressive. Yet, of those 51, just 11 outperformed the overall market the next year, and some of those 11 have turned in below average performance since. Beating the market consistently is tough. Even in a fully efficient market, analysts can earn their keep, though. For example, we may not have good trading strategies to make you money, but we sure know some bad ones that'll cost you. Examples include churning or trading too much. That's just incurring transactions costs. Failing to diversify gives you extra risk with nothing in return. And you can easily give the tax man more than his due. Financial advisors are a lot like doctors in that sense. We've all had lots of medical experts give us good advice. Avoid tobacco, eat a balanced diet, get plenty of exercise. Keeping clients from making mistakes is a big part of financial advising. For example, a good financial advisor can help keep your risk levels where you want them to be. An economist friend, Alcott Allen, came to my office one day. He was clearly troubled. Allen was well aware that markets are pretty efficient and that trading just ran up transactions costs, but he just wasn't comfortable with his portfolio anymore. Why not? I asked. Well, he said, I started investing when I got out of school 25 years ago. I put something away every month, and now it's worth much more than I expected to have. You're making that sound like a problem, I said. Allen explained. I feel like I want to take something off the table and put it in something safer. But that doesn't make sense if I'll pay transactions costs and if prices are fair, does it? What Allen had missed was that his investing strategy was ignoring his risk tolerance. He started many years ago with maybe $1,000 in safe assets and $1,000 in stocks. When he came to me, he had about $10,000 in safe assets and many, many times that in stocks. Instead of being evenly balanced, he was way overinvested in stocks. He needed to sell some stocks and buy something safer. Allen needed to rebalance his portfolio. My friend's dilemma had nothing to do with whether or not the market is efficient, but he did need some financial advice to correct what was, for a person with his risk preferences, a bad portfolio error. Some strategies that you'll hear about from financial advisors and financial media really are good ideas, but not for the reasons people think. For example, some people advocate an investing strategy called dollar cost averaging. Dollar cost averaging